Yeah. You got it?
Well, hello. What a surprise, everybody. Good morning. Dave Kellogg here for the H.O.M.E.S podcast. I'm joined by my regular co-host, I'm his regular co-host. I don't know, we're co-hosts. and I have a client of mine across the way for a very time-sensitive conversation. But Jeury tells me this is episode 38, so on him if it's something different. And this year we're running a little different style, right, Jeury? We're going to do once a month, but 2 at a time.
Exactly.
So we're going to do 2 half-hour formats. We're going to be fast and quick and maybe the same thing, maybe not the same answer, but hopefully it's something easier to listen to on a shorter ride to work than our normal format.
Exactly.
Exactly. So here is, we are in the beginning of February 2026, and Jeury, take over.
This is the first episode of the new year, right?
I don't know. I want to say that,
It
but I
is.
wasn't sure. I didn't want to
It
go on
is.
that limb. You know? It
is.
Oh, wow.
Well, then Happy New Year.
Exactly. So, bringing in the new year, we have a special guest.
Nicole Green, who is a client and friend of mine. She is an investor, and she's here not only to talk about how her investments might affect what she's here for, but it is February, and which means tax season's upon us. Nicole,
Boom, boom, boom.
please introduce yourself, your experience, and what you're here to talk about, the lovely taxes.
Hi, David. Thanks again for having me. It's a pleasure being here. I'm Nicole Green Curtis, and I'm an enrolled agent with 20 plus years of experience in accounting, finance, and now tax strategies. I've been working with BNY Mellon. Post. Because I'm no longer with the company, 20 plus years in finance and, handling a lot of, multi-million-dollar investments. And now I'm gearing towards, focusing on helping, individuals and real estate investors and agents, saving some money on their taxes and to, reduce their tax liabilities.
So that's a nice long training process. You got paid for it, and now you're ready to take all the best lessons and launch your own business.
Correct,
So
yes.
do you plan to have a brick and mortar? Or is this gonna like hey, come by Nicole Green's accounting or what have you in Schenectady, or is this gonna be I do this from home?
Currently, I'm virtual, so I can be working, but I'm looking into coming into Schenectady to get my office. So
We like that.
David's supposed to, he knows I'm working on that.
Hey,
So
another property?
He has to get me maybe a 4 family, so I could be, have my office
Love
in
that.
one, based on the fact that I'm here pretty much with my investments in this area. So I'm pretty much, trying to, help as much as I can here in the area and trying to invest some more.
I love that.
So I want to tell you how local she is. Our first 2-family was in Albany,
Yes.
and then we picked up an 8-unit on Barrett Street.
Correct.
And with some vacancies. So if anyone's looking for rent, today's the day. Let's go.
Yes.
And then you just picked up a really cool one, a do-it-yourself kind of thing, need work, 2-family up in Amsterdam. So you have, not a ton of density, but you have a little bit everywhere. So you're going to start feeling like, hey, maybe this town does things differently. And I think that's a nice wide stance to kind of be going into a tax. You have someone that's doing investments on their own, and they are going to have the same troubles that you and I might have.
Exactly.
Right? Because running your own business is not unlike being a real estate agent. We run our own business. Right? We're responsible for our bottom line, as it were. And tax rates are important for everyone because it's not what you make, it's what you keep.
Exactly.
Yeah,
I've heard that.
So that's
I stole that. Yeah.
Well,
correct. That's correct.
yes, I want to ask you a question, Nicole.
Sure.
What are the biggest tax mistakes first-time buyers and new investors make?
When, in reference to that is actually due diligence.
Okay.
So due diligence is one of the main, things that the mistakes that we make, sometimes with making sure that, for the investment purposes, what needs to be done and, do the background checks, and, stuff, making sure that you're seeing those rent rolls. It's very, very important seeing the rent rolls if you're in rental, seeing the proof of the rent rolls. And that's some of the mistakes sometimes I've observed, I've seen.
Okay.
So far, not doing the due diligence part of directly checking the rent rolls.
Gotcha.
Yeah.
So I guess on top of checking the rent rolls and doing your due diligence, what are expenses first-time home buyers and new investors can write off when filing for their taxes?
Yeah, for tax purposes, for the investor, normally, the tax pieces, the insurance, and then the beginning startup costs is normally tax deductible. And also one of the main things that I do find happening is trying to make sure that you're keeping your receipts, the mileage, your time being spent, going out to dinners. A lot of people miss those little tiny things, like when you go out for lunch, keeping those receipts, making sure you're keeping those logs. That's one of those main things that you have to, you lose a lot and you leave a lot of money on the table by not, keeping track of your expenses.
That can be a hassle a little bit.
Yes,
it's not a hassle if you have a shoebox in your passenger seat and you shove all those receipts in there. At the end of the year, you're like, here you go.
Yeah.
Right, because tax strategy only matters in February of the following year, right? That's the only time you have to think about
Oh no,
things?
that's the thing. When by the time you get to that point, it's too late.
You mean I can't go back and find a receipt from that one dinner that one time?
No, you can. But normally, in order for you to effectively maximize on your deduction, it has to be something that's been done throughout the year.
Yep.
So it's not, if you, come to me in February, a lot of stuff that should have been done by December 31st, you already, missed that mark. Because there's a lot of strategies that has to be in place throughout the year.
Gotcha.
So it's always good to have your finances or have someone working with you throughout the year, not at the end of the year.
Correct.
So if I do get someone now, that is already, it's okay. It's a start. Mistakes do happen. But, going forward, this is what you need to do to be consistent and to maximize on your tax benefits and your tax deductions. Yeah.
One great app I use a lot for tracking my mileage is MileQ.
Yes.
That's the best. It separates personal from business, and you could set it, forget it, go home, and then kind of sort what you did.
Yes.
But when it comes to lunches, I'm still having an issue when it comes to a business lunch or a personal lunch to keep those receipts and then kind of, do it that way. What would you suggest people to do when it comes to
normally for the small startup, if they have, like maybe QuickBooks, some, people can track, or now with your, the phones, and you take pictures of your receipts, because most of the time you end up losing it, so it's just trying to keep, taking pictures of your receipts. And if you have young kids, if you have little children under the age of 6, up under the, young kids under the age of 18, you can also utilize them to do that.
So Jerry's over here poking me because I got one behind me.
Exactly.
So what we have here is what I've heard, and I've never had a chance to do it because I don't have enough free money to give it to them. But can't you give money to your kids and let's say they help in advertising, help organize the business, that you can basically say I paid my children and actually do pay them $10,000 each and write that off? Isn't it something up to $13,000 a year you can write off?
Yes, up to the standard deduction, but again, paperwork and paper trail. So you have to identify the work that the child is doing and what they're capable of doing at their respective age.
They can lick envelopes.
So
and put
exactly.
them in, and put
so
them
you
in
put
the
it.
mailbox.
So you have to have that noted. That, for example, you say, okay, Charlotte is my assistant and she does the office work of, taking care of my receipts and plugging my receipts into the system and she gets paid XYZ for doing that. And that's how you go about doing it.
So as of right now, I don't claim my kids, but Charlotte does help me. She's my oldest, and we're in the car and I'm yelling at my car. I'm like, call blank blank lender, call lender, and the phone doesn't want to listen. The car doesn't want to listen to me all the time. So I hand her the car, and every time she makes a phone call or answers it, she's like, "Hey, this is Charlotte. This is Dave Kellogg's assistant. How can I help you?" I give her $1. I'm all out of dollars. But she's like, "Give me your phone." I'm like, "Let's go to work." I'm like, "That's cool."
Yeah.
So then you're teaching her, but then for your tax write-off now.
I got about $9 into this program so far.
It adds up over the year. It adds up. So most of the time when you do have children, instead of you giving them here's your allowance. You're working for the allowance, and now that becomes a tax write-off.
And the standard deduction.
So you're going to give them that money anyway.
Exactly.
So might as well you have it written out as a business owner, that they're actually working in your business, and that's how you have to, you can write off your kids, So that little maintenance dirt you don't want to do. Yep, you have 2 girls, and you just put them to work to keep you organized.
I got 3.
Yeah, until, she's not ready
yet. The littlest one,
she's
all
not
she
ready
has to do is hold the camera, and now she's a TV exec, right?
Okay.
Or sit behind us and yell,
there you go.
Action,
exactly.
before we
So
start.
she can be on your payroll.
Yeah,
exactly.
Absolutely.
She's filing taxes as we speak.
So you can, all 3 can be on your payroll. And that could save you a lot of money.
There you go.
There you go.
So I feel like I probably need to sign up for something like this. And also,
Absolutely.
I believe you can write off the cost of tax prep on your taxes.
Yeah.
Oh,
Professional fees.
man.
But if you have Nicole Green, you don't even have to.
Well,
And
I'm
rolling your
going
tax.
to pay her, and then she can give me a deduction for the following year. Absolutely.
Absolutely.
Oh.
Yes.
So, me and David work with a lot of first-time home buyers, new investors, and they often ask, why get a home versus buy a home? Can you explain why it's important to own a home sometimes when the time is right versus renting because of these benefits when it comes to tax write-offs and different things you can write off?
Yeah, well, when it comes on to owning the home, if it's your personal home, there's not much that is deductible. You know, the part that is deductible if you have a small business and you run it from your home, then you have the home office deduction. But that's it, and which is a portion of your expense it can be written off because you're running your business from your home. But outside of that, if you want to capitalize on the major, write-offs, then if you have a rental property, then that's a different, story than everything else. That expenses that pass on is 100% write-off. If you have a rental property, but for your personal home, unfortunately,
It's zero to nothing.
It's zero. Yeah.
To not detract from owning your own home, because
Yeah.
this is our job. You get mortgage
But-
pay down, you get active equity gain. That means when you do the work, and you get passive
Yeah.
equity gain. That means when the neighborhood goes up.
Yeah.
So you get active, passive, and you get mortgage pay down. And my biggest thing is, we talked about this once before. You're in control of your future.
Yeah.
No landlord's going to say, hey, my cousin's coming from out of town in 3 months. You're out, they're in. Oh, it's right before Thanksgiving? What do you want? Frozen turkey as a sorry? Get out. So you do gain a lot of control that way.
Right.
And you get those passive, active equity gains, and you get mortgage pay down equity. So there's a lot of benefits.
There's some benefits there still.
Yeah. Remember, I think we talked about this like a year ago. Some guy asked me, what's the ROI on a personal home? I'm like, ROI is knowing where you live. ROI is having control. If you want to get a dog, get a dog. That's you
Exactly.
now. That's not some guy that looks like us or someone that's just an entity corporation name that says no dog.
Yeah.
Return the puppy at Christmas time.
And for your personal home, another thing as well, if you do use it as a part of your home as short-term rental, and then there's a lot of other tax advantages if you do the short-term rental through your home, your personal home.
That's interesting. We
yeah.
won't talk about short-term rentals in Schenectady specifically because I don't think they have a ruling. So therefore, if there's no rule to allow it, there's no
there's a rule here.
There's a lack of, I believe it's a lack of rule.
Oh.
But midterm is fine, which would be something like 31 days to 3 months is totally cool, right? Because it's not short term all of a sudden. But that's a rule and regulation that can change and probably does change often. I don't want to get too deep into that.
But that's for most of the other states or towns, short-term rental is another way you can actually to maximize your use of your home, your personal home.
So Nicole,
outside.
you deal with money and returns, and you handle big accounts and small accounts. You yourself are a property investor. Do you feel like that property investment and a proper tax strategy is a good, healthy, safe move forward for people to put their money?
Absolutely. And that's the reason why I'm actually gearing towards the real estate investment for the passive income side, in which my physical, I can earn, the passive income instead of, physically exchanging time for dollars. So that's my gear of trying to, improve from my retirement, section of it is not to be swapping time for dollars. And passive income is where you can save, a lot on, you have your passive income coming in. So that's my reason actually for going into real estate investing.
Is better returns and
Better
safekeeping
returns
for
on
your
your
money,
money. Yeah,
and then
absolutely.
you're willing to help out similar like-minded people.
Because actually, for example, for my second unit, the 8 unit, actually I used my 401k.
Yeah.
And my return on investment is just way more because, for $50,000 to, pick up, a $500,000 property, I would not be having, and the ROI on that, I would not be having that if I had that $50,000 in my 401k.
That was Schenectady of 4 years ago? It's a whole different world now.
2022, yeah, so it's 4 years.
$400,000, $500,000 buys you a 3-family now instead of an 8.
Wow.
Right?
Yeah.
But there's also plenty of places that Jeury and I would know that you could still pick up something like that. It's just not in the heart of Schenectady at this time.
I don't know about 8 units.
Yeah.
Once you get above 4, it becomes rare.
Yeah,
right.
exactly.
Like every now and then you see a 5 or 6, but like
8.
I noticed because I've been looking and it's just not.
It's tough to find.
You were blessed, especially with this guy.
Yes.
He is good
Dave
to come
Kellogg
by.
right here.
Thanks to Dave. Yes.
let's hit one or two more quick ones, and then
Yeah, I guess where I want to know is when it comes to long-term strategy, sellers are always asking if you're an investor, what is a 1031 exchange, and what can people do in order to maximize that?
The 1031 exchange is, within the 90-day period in which you sell a property and then, roll it into another one, to another property within that window. So there's a window in which you have to do that transaction, the 1031, in which to save on, the taxes that you actually would incur, or the capital gains that you will incur from selling the property. And so it's just rolling it over into a new property.
Gotcha. And it has to be from an investment to another investment, correct? It can't be like your personal going into an investment.
You could, correct.
To avoid capital gains.
Yes.
It's basically just a deferment of taxes.
Yes,
If
to
you're
defer.
if you're going to make $300,000 on this investment, you're going to owe 25% tax on that. So instead of paying the $75,000, you say, okay, I'll just put it in a bigger one.
Correct.
Yeah.
Right, but I've only done one. Like I went shopping, and I know you had to identify one before you identify the next one before you sold the first one.
Yes.
Right. That's a whole different.
Yeah, so they both work simultaneously. A lot of people do it for their personal homes as well. Like if you want to, relocate from one area to the next, again, some people do that. But then, of course, there's, they have the limit or the caps on the amount, for you not to pay capital gains. But a lot of people, for their personal homes, they do that as well. But the 1031, just to roll
it over into the other investment.
Into the other, yes.
Now, when it comes to minimizing capital gains, what are those ways to minimize capital gains? I know from experience, if you live in it for 2 out of the last 5 years, you can
correct.
You can minimize, but depending if you're single, married, there's a certain amount. So
absolutely.
Can you go into detail about that?
Yeah. So with that, pretty much you nail it on the head. Is normally the time span for that in order for you to move from one to the next, to save on the capital gains, of course, to exchange. Then that's the way to to go about doing it within that window. So you don't have to pay attention and pay some time. Yeah. And that's why it's always good to actually have someone in your back pocket, like a good tax professional that keeps ahead, because when you're busy doing your investment, sometimes you don't have the time
sure.
to pay attention. So that's where your tax professional comes in. That will help you out if you have that real good connection.
Gotcha.
And let them know that this is what I'm planning to do, these are my goals. Then they will have the eye out for you on your next steps. Yeah.
Gotcha. Okay.
So what I take from that is either live out at least 2 years, so you don't have to keep track of stuff.
Yes.
Or if you're going to do it shorter or faster, have a good tax professional help keep your money.
Correct.
Makes sense.
Yeah.
Did you want to touch anything else? I think we're...
Yeah, the other thing is too, because I do help small business owners as well. And also another thing is the commingling. Commingling funds, sometimes that is another, big problem. So it's best for you to try to keep your business expense and your personal expenses, keep it separate. And that's one of the main things sometimes that happen to small business owners and even real estate investors and agents, or so brokers, is just trying to keep your expenses, not to commingle. So that's a big thing.
So if 2026 is going to be my year, or to the listener out there, your year, dear listener.
Yeah.
If they were going to get ready to go talk to Jeury, right, because we're here and crushing it, would we want to talk to the professional and say, hey, this is the 2 or 3 different things I want to do this year, next year, and over the next 5. Can you help me before I buy a property? Is that like a conversation to have before picking up a property, or should we just go for it?
No, sometimes it's best to have, because you want to see where your financial status is at the moment, what your goals are, so you can actually work together to see, so again, it comes in with your credit score. Let me see what your credit score is, because the better the credit score is, the more marketable and the more you can actually, you would say, with the credit score does play.
There's a lot of opportunities.
A role. So there's a lot of things that you can negotiate as much if your credit score. You can get properties, but then you can't negotiate as much if your credit score is low or within the low 600s. So the rate is going to varies by that, and stuff like that. But most of the time the main goal is to making sure that you actually you have a net income.
Gotcha.
So sometimes the tenant is going to be paying your rent. He's paying the mortgage pretty much. So you want to make sure that your mortgage has been covered. So then sometimes the interest rate, if you have a little bit high, because my first property, for example, I had that situation. I was back and forth, as David could tell you, back and forth with the broker. They gave me a 6-4, they was having me back and forth. The bank just held it up for no reason. They approved me, then it did non-approve.
This is the Albany? This is in Albany?
Yeah, the Albany one. Yeah, so
that's been a good property for you. That's been good.
You know, so at the time the rates were extremely low. I could have gotten it at 3.75, but then he dropped the ball, and by the time I get in, you know, so I had to get it, you know, at 6%. But at 6%, I was still cash flowing, so it makes sense.
Yeah.
But but it's based on the knowledge and actually doing a lot of reading and research into real estate investing. Because just my regular mind, I would think, oh no, that's crazy. I'm not paying 6%.
Exactly.
You know, and I could get it for 3.75. The interest rate is too high. But when I talk to, you know, seasoned real estate investors, they were like, you're not worried about the interest. You're not paying it. Your tenants are. So as long as you're cash flowing, that's what's important. So you got to make sure that you're cash flowing. And the property has been doing excellent at 6%.
I love that.
That's nice.
There you go. That's
Nicole, how would someone listening or ourselves get a hold of you?
Well, you can, Nicole at NNGTaxAccounting.com and www.nngtaxaccounting.com. And I also help with IRS, you know, issues as well. I'm an enrolled agent, so I do, you know, if you owe anything $10,000 plus and you need to, you know, figure out what's happening.
That is not I.
Who doesn't? That's so funny because I'm
That's
like,
not me.
who doesn't owe $10,000 plus to somebody out there?
Yeah, so if you do, for the IRS also, I do representations as well.
That's cool.
Yeah.
Cool. Any final advice for those who own homes or going into the tax season to be aware of? Just keeping receipts is one, obviously. Anything else?
Yeah.
Separating your personal and business accounts.
Yeah, that's one of, yeah. Pretty much, yeah, that's what it is. It's actually, you know, being accountable and actually, you know, keeping a hold of your expenses is just one of the main things that you can capitalize. And of course, speaking with your, you know, tax professional, tax strategist, you know, someone to, you know, to make sure that your money is working for you. Because that's what, you know, you want to keep most of your money. So you have to, you know, want to work with a tax professional in order to make sure that you're maximizing on all your benefits that you have. Because there's a lot of benefits out there that a lot of people do not know. That's another show.
And well, we'd love to have you back.
Yes, absolutely.
Yes.
Thank you, Nicole, for making time to come.
Thanks, and thanks
a
for having
pleasure.
me.
Thank you.
Thanks for having me. It's a pleasure. Thank you.
The H.O.M.E.S podcast is a co-production between the City of Schenectady and Open Stage Media. For more information about OSM, visit openstagemedia.org.